I'm Michael Smith.
I'm Chuck Osborne,
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
It's Wednesday, August 2nd, 2023. This is the fourth episode of the Iron Capital Podcast. Woo. So let's get to it, Chuck. What's on your mind?
Public service announcement, Michael. Public service announcement. It is 11:30. Do you know where your money is? All right. Just in the last week, this is nuts. I got to go to the glasses here. Sorry. In the last week, LPL, broker-dealer out of Boston, was rung up for $3.1 million. One of their brokers had stolen $2.4 million in client funds. The next day, SEC charges veteran FA for stealing $2.4 million from elderly clients. This was a different firm, a different location. This was a dual registered advisor with 26 years industry experience and stole $2.4 million from an 87-year-old. And just this morning, as we were planning on doing this, yet another one.
Oh, my goodness.
$35 million stolen in a Ponzi-like scheme in Florida by a church member who had convinced his fellow church members to give him money. 60 people gave a total of $35 million to this gentleman who primarily used that money to live on. And that is kind of crazy. So we think about the worst parts of our industry and how people actually have their money stolen from them. And so much of that goes into how we're structured and why we're structured the way we are, and getting people to understand the importance of that. I think it oftentimes gets lost.
No, I think
what's on my mind.
We're going to get into it then. Yeah. So, like I usually like to do, let's talk a little bit about some of the larger investment frauds and Ponzi schemes, and what some of those have in common. And we'll start off with ways, some of the easy ways to stop that from ever occurring,
Right.
And then we'll go down from there. But I guess what is a Ponzi scheme, Chuck? People throw that word out all the time, and when that is talked about, what do you think of as a Ponzi scheme?
Right. So the Ponzi scheme goes back to, if I recall correctly, there was a guy whose actual name was Ponzi.
Charles Ponzi.
Charles Ponzi.
Yeah.
And you basically, what happens is you promise investors a great return in this mysterious, hard to understand. It's always complicated, Michael.
Yep.
It's always complicated.
You wouldn't understand. Just trust
You're
me.
right. You just trust me.
Trust me.
You're going to get, a big return. So the gentleman in South Florida was promising anywhere from 18 to 43% return.
Probably guaranteed.
Guaranteed. He did. He did use that word guaranteed,
Probably
according to
guaranteed.
the article. Yes. And what happens is you get the money from the client and you don't invest it at all. You're just stealing their money. But what you will do is you will actually pay back part of their money to them, or as you get new clients, you actually give that money to the old investors. So the investors believe
That they're making a return.
Because they're getting these dividends. And then they will, tell all their friends that, this guy's got the secret. You don't have to.
My investment doesn't ever change.
It
The
never
market
changes.
goes down, but mine doesn't. Look at this piece of paper I have that says nothing changed.
Exactly. I have a piece of paper that says nothing changed. And when I've asked for money,
They give it to me, which is the biggest.
So that convinces them that everything is legitimate, and theoretically that can just keep going. But what ultimately happens is it implodes. There's not the money, the money's not there to give to clients as they need it, and people start raising red flags, and they find out that it's all a big scam.
And I don't know the details of these, but these often come out after a significant market downturn. Mm-hmm. It's very normal. So the two largest that ever occurred, which Bernie Madoff, which came out in 2008, that was I think a $20 billion scam. Alan Stanford came out in 12 or 13. It was not far behind the downgrade of the U.S. debt and the European debt crisis. That was $7 billion. Right. Both of those were guarantees of some wild return that you couldn't actually get in a safe way. But I think it's important to note what almost all of the big Ponzi schemes, what almost all of these ones we're talking about involve are this idea of custody. So let's talk about what custody means. And I think it's easy to start off and say, what happened with Charles Ponzi? He had people give him cash. Right. They didn't put it in a bank. They didn't put it in someone else to hold money from. They gave him money directly, and that's a form of custody. Right. But talk about how custody works in current day. Yeah.
And I'm going to, I'm often accused of splitting hairs, but I'm going to correct your grammar. Okay. It's not almost.
It's all.
It's all. There is no way to steal a client's money if you don't have custody.
Yeah, that's true.
Of the assets.
Good point.
So custody is king, and it's basically when you have an advisor. Anytime you have an advisor that says, give your money to me, or to my firm, and so. This is where you get, again, the distinction in the industry that we've talked about before in a previous podcast. We talk about all the time with our clients is the old buy side and the sell side. So we are an investment advisor. That is our job. We are not a financial institution. We give advice for a fee. That's what we do. We represent our clients as a fiduciary. We sit on the same side of the table as they do, and then we manage their investments on their behalf. We, and everyone like us, has to have those portfolios at actual financial institutions, just like the client would if they were doing it directly themselves. Mm-hmm. And so the financial institutions in question, when most of the time when you're talking about investments, are broker-dealers. These are registered with the SEC as a broker-dealer. They deal in securities, and they broker securities, and they custody client assets in an account where you buy and sell securities. And the ones that we think about today are, Charles Schwab. We got TD Ameritrade, but they're about to be the same. Fidelity. You got Merrill Lynch. Mm-hmm. You've got Morgan Stanley. Mm-hmm. These J.P. Morgan. And so some of them are also banks, but they have broker dealers where they actually custody the assets and the securities. And so, securities, and we still occasionally will get this. You'll have a client call us, and they got, my dad or my granddad had these actual stock certificates in a safe somewhere. What do I do with them? Most people don't keep stock that way anymore. Most people keep it at a registered broker-dealer in an account under their name. And so it's the broker-dealer that has custody of the assets. And this is why it is so important that you separate the actual action of advice from that custody. All right, so in each one of these cases, you had a situation where the people were acting as an advisor and as the broker-dealer or as the custodian of the assets. And because they were on both sides of the table, they're able to steal the money.
They were able to steal the money.
Yeah.
Yeah. Well, and this is a great point to talk about, the idea of a dual registered firm. and the history of that, I think.
Right.
So, historically, prior to '07, you had registered investment advisors, which is what Iron Capital is, and others like us, and then you had brokers and registered representatives who acted on behalf of the brokers.
Right.
Why don't you talk a little bit about that and how that changed a little bit?
Yeah. So there's a little vocabulary, the industry vocabulary you have to get used to here. So the broker dealer is the firm itself. So Morgan Stanley is a broker dealer. Your advisor at broker dealer is technically a registered representative of Morgan Stanley. All right. So the advisors, brokers, whatever you want to call them, they are registered representatives of the broker dealer. And as we often speak about and have already in an earlier podcast, when I first got into this business 30 plus years ago, there was just a separated line. You were either a broker, a registered representative, a broker dealer, and you were on the sell side of the business. And you made it clear to your clients that we are selling securities. Yep. I am here to sell you whatever it was, whether it was an individual stock, a bond, a fund, whatever. The relationship was very clear that these were salespeople representing a financial institution and products that financial institution was selling. Or you were an advisor. And most of those advisors are often referred to as money managers, where people were hired primarily by institutional investors or very high net worth investors back in those days, because to make that worthwhile, you had to have a lot of assets. But they would hire a money manager who would represent them, again, as a fiduciary, and make investment decisions on their behalf. And so the industry was completely separate, and it was very clear. So what happened sometime in the mid-'90s or so, I believe it was Merrill Lynch, started to charge fees for doing things like financial planning. Mm-hmm. And so in addition to their traditional business of we sell a product, and when we sell a product, we get a commission.
We make a commission. The way they made money was making a percent of the sale of the product.
Yeah, because they were salespeople. And so we're very accustomed to salespeople make commissions.
Yep.
So, I sold you a stock, I get a commission. I sell you a mutual fund, I get a commission.
Yep.
Right. And so that's, that was their traditional way of making money. They wanted to expand their business beyond that, and so they decided that they were going to get into financial planning, and they wanted to charge a fee for the financial plan. So not only are they making money on the commissions of products that they sell, but now they're also going to charge a fee for creating a plan, which, shockingly, is going to recommend that you buy a lot more products.
Yeah.
And so that was the beginning of it. And then there was a national organization called the Financial Planning Association, didn't like that. They didn't like the idea that these brokers are now presenting themselves as financial planners. They sued them and basically said that if they're going to do this, they actually have to register with the SEC as an investment advisor so that they can give fee-based advice
and take a fiduciary responsibility.
And take fiduciary
prior to this,
responsibility.
If you're a registered representative, you don't have a fiduciary liability to your client. You don't have to work in their best interest. You're working in the interest of your firm.
Right.
It has to be suitable, but you're working in the interest of your firm, and you're looking out for your firm's best interests.
Absolutely. I mean, you're a salesman, just like any salesperson.
Just like any salesperson.
If you go buy a Toyota and you go to the Toyota dealer, the person you're talking to is working for Toyota.
Yep.
That doesn't mean they're a bad person. Doesn't mean they're going to sell you a lemon or anything else. It just, that is the role that they are in. They are not in the role of a fiduciary. who is a person you pay to act on your behalf in a certain, manner. In this case, making investment decisions. That's not their role. Their role is to sell products, and it goes back to something that our clients used to tell us. We have clients of a certain age now; they're getting older and older. Those that are still alive. That we would ask them the question when they came is like, who manages your money? And they would say, I do.
Yeah.
And Bob at Merrill Lynch has been my
He's my broker
for forever.
Yeah.
And that's the correct description of that relationship.
When I want to buy a stock,
right?
I'll tell Bob I want
right,
to. He may tell me some of his opinions on some things.
Oh, sure.
But I'm the decision maker.
Because he's a good salesperson.
Mm-hmm.
But his input is that of a salesperson.
Yep.
It's just like when you go to buy a suit from a person that maybe you've bought several suits from. They kind of know what you like. They know what you own. And so they're going to give you a recommendation. But at the end of the day, they're still selling something to you. They're not, a objective advisor.
So after this suit, right?
Right.
After this, post 2007.
So in 2007, yeah.
We now have the creation of what are called dually registered representatives, right?
Right, you do. And then again, this gets into the problem which we talk about all the time, is that you have salespeople who are still salespeople, but they're calling themselves advisors. And in this case, they're actually been able to be licensed, so to speak, to do both of those things at once. And it causes an enormous amount of problems.
Conflicts of interest left and right.
You just think about that. If we were dual registered, which we are absolutely not, but if we were in that situation, then we could create a product that we're selling that we make a lot of money on, and because we have control of our clients' assets, we could just put them in the product, and now we're double dipping.
We're getting paid twice.
We're getting paid twice.
The management fee from the product plus our fee on top of the whole thing.
Right, exactly. And that is why you don't do that. And that's, frankly, the best case scenario. The best case scenario is you're dealing with someone who just has an enormous conflict of interest, and you're getting something that's probably not really in your best interest. It is probably more expensive than you need to pay. It's probably not going to get you the returns that you could get elsewhere, et cetera, and so forth. That's the best case scenario.
Yeah. The worst case scenario is what we're talking about here, right?
The worst case scenario is they're able to walk off with your money.
It's a situation where fraud is much easier to commit. Let's talk about some of the data, right?
Right. Yeah. So we're not the only people who have noticed this. So that it is very important. I think a lot of people have probably not heard it because you don't hear this much. But this was a paper written in 2019 by Nicole Boyson. Hopefully, I'm pronouncing her name correctly. She was an associate professor at Northeastern University. Did a little research. First, interesting little tidbit.
Well, first let's say the name of the research paper, which I love.
Oh, really?
It's The Worst of Both Worlds, Dual Registered Investment Advisors.
She does put a question mark there.
That's true.
But I think at the end that's answered in the
she answers that this is the
affirmative.
Yeah.
All right. So right off the bat, a couple things that jump out. 81% of the assets in registered investment advisor type firms are with people who are dual registered, which is frightening, quite frankly. Interesting, this was written in 2019. The SEC, she said, had identified this as one of their top priorities in 2013 and 2014. There's just an article out earlier this year. It is also the top priority in 2023. This is not going away.
Yeah. The main regulatory body that regulates these people, just the fact of being dual registered is one of their top risk alerts.
Right. Absolutely.
Set up one.
Set up one. And as is the case with most academic papers, she quotes in a lot of other papers. So you've got a gentleman named Dimmock, or two gentlemen, I guess, or individuals, I should say. I don't know that they were gentlemen. Dimmock and Gherkin in 2012 did a study and found that simply being a dual registered RIA is a strong predictor of subsequent fraud. That's a pretty strong sentence.
Just being dual registered,
Yeah.
compared to independent RIAs.
Absolutely. They, in a later study, found that being dual registered led to a 50% more likely to commit misconduct than standalone brokers, who also were more likely to.
So brokers themselves were more likely than RIAs, than independent
Right.
RIAs, but dual registered, again, kind of the worst of both worlds situation, were worse than even the brokers.
Yes,
Were.
in terms of actually committing misconduct. And I think it's important to make a point here. And you've heard me say this several times, but incompetence is far more prevalent than malfeasance. Most people in our industry, including all the dual registered individuals, are not bad people.
Yeah, these are not bad people. These are people we know. These are family
right.
members sometimes. These are people trying to do a job.
They're people that you meet at church.
Yeah, people that, yeah.
Right. They're not bad people.
And the vast majority of them, are normal, good people.
Yeah, even the people that end up committing the most horrible frauds don't start out being
That's true.
bad people.
Yep.
I mean, Bernie Madoff did not start out as a fraud. He started out actually trying to manage money. And he had some early success. And then he started making promises that he couldn't keep.
Yeah.
And when he couldn't keep them, he tried to hide them from his clients.
Mm-hmm. Started with little lies.
And just step by step, it ends up becoming the biggest Ponzi scheme in the history of financial markets.
By the way, because he had custody, he could do those things.
Right.
He could go in and doctor statements and say a different value. There wasn't a third party, right?
Well, I don't know if he doctored them. He created them. I mean, he just
typed in whatever they wanted.
He just typed in whatever he wanted and printed it off.
Yeah.
Yeah. I mean, that is that is really, it is what it is. You have a situation where you've given somebody custody of their assets and you've created the ability to do this, and you got to understand, like in the case of Madoff, it's an enormous temptation.
Yeah, it's a temptation.
And ultimately what happens is these conflicts of interest, they have a much bigger impact on people's behavior than people think. Everyone thinks, and there's been tons of studies to back this up. Everyone will, they'll sit there and go, "I'm a good person," and most people are. I'm not, I'm going to do what's in the best interest, even if it isn't in my best interest. And then they test it time and time again. The conflict of interest wins out.
Yeah.
And when you are in a situation, which happens a lot of these, and part of the reason why they come to light during bad financial times is because the first people to feel the pain in bad financial times are people like us. They're the investment advisors, because as the market goes down, our revenues goes down, and we get hit first. Now, if you're prudent, you plan for those kind of things, and you make sure that you can survive those situations. But what often happens to these is that they haven't, and so then what do? They cut a corner.
Yeah, if you're structured improperly, you can.
Right.
Again, if you're in these situations and your kid has to go to college and you have to pay for that, and
Right.
you have the ability.
Right. You
Because
have
of
the
how
ability.
you're structured, you could go take money and you could
Right.
make the promise that you're
Right.
just going to put it back.
Right, and exactly. I'm just going to, you're like Dumb and Dumber. That suitcase is full of IOUs.
Yeah.
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 And every one of those is good. And that's That's how it works.
Let's talk more
So
about what Nicole Boyson found in her actual report, because I think some of those things are really important.
yeah,
Um,
yeah.
I can go through some of these and you can talk to them. One of them is the dual registers. They sell insurance products to their clients. As
Right.
an RAA, for what we do, we can't sell in products. We can't make money from that. Why is selling an insurance product to a client a problem?
Well, it's enormous conflict of interest.
Yep.
I mean, because people who sell insurance get paid a lot of money to sell insurance. And when you're making a big commission to sell a product, that is an enormous conflict of interest. The other thing that happens, and this should be common sense, but in the financial world, it's not. People, our education system does a horrible job kind of educating people on personal finance and what it means to invest versus insurance versus all of these things. And people just think that, well, you're in the financial world, that means you're a finance guy. And that means that you know things. So someone who sells insurance should certainly be able to advise on investments. That's absurd.
Completely different.
It's
It has nothing to do
completely
with each
different.
other.
Right, and that's isn't an insult towards insurance people. Insurance is very important, but it's just like saying that you don't go to your dentist when you're having chest pains. That's not to say that dentists are bad people or that you shouldn't visit your dentist twice a year, but they're not cardiologists. If you're having chest pains, you go to the ER and they put you in front of a cardiologist. Just figure out what's wrong with your heart.
Yep.
You don't go to a dentist.
Yep.
You don't go to an insurance person to get investment
Yeah,
advice,
or vice versa.
or vice versa.
Yeah.
Quite frankly, and it should be pretty simple, but unfortunately, it's not.
Yep.
And obviously, the insurance person has the conflict of interest of, I could make money on advising you with investments.
Yep.
And frankly, what happens in those cases is it's the home office that does everything. All the insurance guy actually does is sign you up on whatever their home office is, selling at the time, and then they go on and try to find a new client, because that's really what their job is to go out and find clients that they can sell insurance to. And so it's an enormous conflict of interest, and it's something that should be simple, but for some reason it isn't. Don't ever take investment advice from someone who is selling you insurance, or for that matter, your real estate agent,
Yeah.
your doctor, your lawyer. These are not the people that you should be asking investment advice from. You should be asking investment advice from someone who's actually qualified as an investment advisor. But it's an enormous conflict of interest. And again, it boils down to the idea, that how much does your insurance agent actually know about investing? How much training do you think they're getting in terms of actually analyzing securities and making investment decisions? The answer to that question is zero.
Yeah.
And what happens is so many times is that these are good people. They don't really know what they're doing. They trust the company that they work for. And so when the company comes out and says, hey, we're going to dual register all you guys, and now you can also make money giving advice, and that's going to increase your income.
Yep.
And we're going to help our clients even more. And you don't have to really do anything, because we're going to do it all from the home office. All right. We've seen that not even with insurance guys. We had a specific, client that you may recall that they had part of their assets with us, and they had part of their assets with Morgan Stanley. and they asked us to have a meeting together, and we were in the Morgan Stanley office here in Atlanta, and they wanted to, have us both in the same place at the same time. And every question they asked the Morgan Stanley team, the answer was usually, well, we'll have to call to New Jersey in our home office and find out.
Yeah.
And every question they asked of us, we just answered, because they have a direct relationship with the people who are actually making the investment decisions. And even at a firm as high quality, and Morgan Stanley is a very high quality firm, their representatives are paid to go out there and find new clients. They are not paid to be actually doing the investment work. That happens in the home office. And the problem with that, and this is what motivated me to start Iron Capital in the beginning, because I was one of those people, is that when I was in Invesco, I never met a client. The client was just a concept to me.
Yeah.
I mean, and so it's very easy when you never actually go face to face with a client to be always thinking in terms of what's good for the firm.
Yeah.
And that's not to say that we're doing something that's bad for the client.
Yeah.
But you always have that conflict of, are we going to do what's right for the clients, or are we going to do what's right for our business? And when the people actually making those decisions are completely removed from the client, it becomes very easy to favor the business over the client.
That is a perfect segue into the next thing that the author talked about, which was, dual registered firms often get paid what we call revenue sharing arrangements, where the mutual funds or the products they're using actually pay the firm itself or the individuals. Talk about that and how that causes a problem.
Right.
Because she found this still happens even in these dual registered situations, where that can't happen with an independent RIA.
Right, it cannot happen with independent RIA. So if you come to someone like Iron Capital, who is truly independent, the only revenue we receive as a firm is the fees that our clients have agreed to pay us. That's it. That's the only source of revenue that we have. So whatever advice we give in terms of making investments, hopefully we're right, but it's always our best judgment as to what's best for the clients. Because ultimately one cannot serve two masters. You can't get paid by the product and be objective. Now with a broker-dealer, that's not the case, all right? These are stores, okay? A broker-dealer is a store where you go to buy securities, just like Macy's is a store where you go to buy clothes. And if there are clothes on the shelves at Macy's, it means Macy's has a business arrangement with, whatever clothing brand that is, Ralph Lauren. Ralph Lauren pays to be on the shelf at Macy's, and American Funds pays to be on the shelf at Morgan Stanley.
That's right.
And it's the same type of arrangement. So
now that's hypothetically. We don't know that American Funds pays for Morgan Stanley, do we?
Well, if they're on the shelf at Morgan Stanley.
So let's just say this is a hypothetical.
They're paying. But no, and I'm pretty sure they are.
It's probably
there's a high probability that they are. But no, that they pay. This, as a matter of fact, I talk about my own experience. So I was in the retirement division at Invesco. We were acting as a custodian of retirement plan assets. That was part of my job. Part of my job was not just to analyze what were the best investments to offer, but part of my job was to negotiate the revenue that we would get, that Invesco would get from the whatever managers we agreed to have on our platform. If you were going to be on our platform, then you had to pay to be on that platform. Just like any wholesale operation has to pay to be on a retail platform. And so that's how that business has always worked. But then again, that used to be the only way it worked. We weren't also playing the other side of being the objective advisor who's then putting you into this fund that is paying us a lot of money to be on the platform in the first place. And now when you have the dual registered situation, you have a situation where those funds are they're still doing the same thing. They're still paying to be on the platform. You now have advisors who are charging a fee to the client to put them in a product that is paying the firm. Okay. Now, again, this is where most of the time the advisors are simply naive as to how the business works. Because one of the things that often does go away in that fee arrangement is the advisor's actual piece of the compensation.
Yeah.
And so
the firm makes more money.
The firm makes money.
The advisor doesn't make more.
But
there's an approved list of funds.
There's an approved list of funds.
That approved list of funds has a much higher revenue sharing with the firm than others, and therefore,
right.
and again, it means. So, we're not the only independent RIA. There's other people that do what we do. We're one person in this, one group in this thing. But someone like us has the entire world of products to choose from because it doesn't matter.
But here's what's scary to me, and this is something I did not realize until in the last couple of days preparing for this talk, and we've looked out there. There are currently approximately 307,000 dual registered advisors out there. For the first time ever, they outnumber the plain registered representative, the traditional brokers that we think of as financial advisors. There are 305,000 of them. There are 77,000 nationwide individuals, these are the individuals, not the firms, 77,000 truly independent registered representative, investment advisors out there currently. So you're talking about there are other people like us, but we are still,
it's still
hugely
much less
in the minority. Over 500,000, over 600,000 are still registered as with a broker dealer.
One way or the other.
One way or the other.
Yeah.
And you're talking about 77,000 that are not.
Yeah.
And that really is, to get to what can the client do, what can the prospective client do, that's the simple solution. All right. If you want to make sure that your money is safe, if you want to make sure that the advice you are getting is actually objective advice and
unbiased.
it's unbiased and it's not conflicted, if you want and really what you want to make sure of is that you don't get your money stolen from you. I mean, let's not ignore the worst case scenario. Don't ever take advice from someone who is an actual registered representative of a broker-dealer. All right? If you're dealing with someone and their business card says securities offered through, all right, then you're dealing with a salesperson who works for a broker-dealer and who is going to have custody of your assets. If that's your choice to work for them, that's fine, but you got to know what you're dealing with. You are not dealing with an advisor. You are dealing with a salesperson who is representing a broker-dealer and who you are basically now trusting with your assets, and not just to give good advice, but to not run off with them.
Yep.
And so that is the ultimate solution. And again, we hadn't brought it up yet, but one of the findings of this research paper, which is extremely disturbing, 10% of the firms that do dual registration
That the author looked at.
that the author saw in her study. 10% higher convicts.
A convicted felon.
Yeah, a convicted felon. You're talking, I mean...
And zero in the group. So she looked at like kind of the 75
Right.
largest of both registered reps and the independent RIAs.
Right.
And of that, 10% of the registered of the dual registered advisors were convicted felons.
Mm-hmm.
Zero of the independent RIAs
were convicted
felons. Zero,
Zero.
not one.
Yeah, in her study. Right.
And it keeps going down, right? I mean,
Right.
21% of the dual registrants had been caught lying to the SEC versus 1% for independent RIAs. 38% of the dual registers violated SEC statutes versus 1% of registered RIAs, of independent RIAs. 55% had an SEC order against them versus 2% for the independent RIAs. 14% had a court enjoin an action on them versus 0.3%.
14%.
14%.
You think about that. You think about that. I mean, what was it, if you got COVID, what was the likelihood that you were going to die of COVID?
Yeah, it was like 0.03 or something, right?
Right. And that shut down the world.
Or 0.3, whatever it was. Yeah, that shut down the world. Yeah.
And we're talking about, a situation where you've got a 14% chance of dealing with someone that a previous client took to court and they lost. The advisor lost.
Yeah.
You've got a 10% chance of dealing with someone who is a convicted felon. You can't make it up.
Well, even the last one, I think this is huge. Over half the dual register in the advisors in the last 10 years had at least one disciplinary action with an average fine of $60 million over that 10-year period. The average number of disciplinary actions was one per year. One per year.
One per year.
I mean, anyway, obviously we're beating the dead horse a little bit there, but it's a shocking set of statistics.
No, it absolutely is. It is shocking, and and again, it goes. Our industry, and as has always in my mind been a problem in our industry, is that it's not a concrete industry. We deal with something that is beyond what most people think about. They just don't have the training. I mean, how many times do we hear our clients, they tell us that, well, we just trust you guys. We don't, people really don't know much about how to invest. And this includes, I'm talking about all people. And on the top of that list would be doctors and lawyers and the people who are extremely well educated
Very
in
well educated.
other fields.
Yeah.
One of the things they talked about Bernie Madoff's victims, which shocked all these people, and the reason that his scam was so big is that his clientele was deemed to be so sophisticated. They were rich. There's an enormous difference between being sophisticated and being rich. And the fact is, oftentimes it is those people that are the most educated, who have the highest incomes, that are the most susceptible to these kinds of frauds, because this is the way they're sold. They're sold to their ego. They're sold to the idea that, oh, well, we have this sophisticated formula that it's very hard to understand, but it's going to make you a lot of money, and they're attracted to that.
Well, and you are one of the special ones that will get access to.
And right, exactly. You are very special, and this also gets into the name calling or name dropping, I should say. I mean, how many times and we get these things where. Just the other day, I got a solicitation from a firm that provides services to firms like ours, and all it was a list of, these are the people that I've worked with. I'd like to talk to you. I have no idea what the guy does. He didn't even mention like, well, what do you actually do?
What are you trying to sell me on?
It's just all, hey, look at our clients. Look how sophisticated they are. Wouldn't you like to be part of that group?
Shocking how much that probably works.
And it works, and that's how these Ponzi schemes work. They get people in, and that's why there's often it's like a group like at this gentleman's church. It was a small group. He probably identified who was kind of the most well-respected person in that small group, and he was probably the first person he targeted to get into the Ponzi scheme. And then everyone said, "Oh, well, they're doing it. We should do it because we, how much we respect him." And that's how these things happen.
Yeah,
So the bottom line is the way we are structured is very purposeful, and it is important. You should never allow your advisor to have custody of your assets. And so we often talk about trust is one of our core values. It is the most important asset that we have is our client's trust. And ultimately, real trust is built over time and relationship. But as Ronald Reagan famously said, you should trust but verify. And when you have a relationship with an investment advisor, your assets should be custodied at a different place. So for us, we are agnostic, so we have assets custodied all over the place, but the majority of our assets are either at TD Ameritrade or Charles Schwab. Of course, they're merging, so that's going to be Charles Schwab.
Fidelity, pretty good.
Fidelity, we have...
well-known, well-respected companies.
Right, and that is where our clients' assets actually are. Yeah. We simply access them to make the investment decisions, to deduct our fee, and that's it.
That's all.
And that's the way your relationship with your advisor needs to be structured. And you need to remember that one cannot serve two masters. If you can't have the client's best interest at heart, when you're working for the store that's selling the investment products. Mm-hmm. I mean, it's just that simple.
Yep.
So
I think that's it.
I think that's it.
All right. Like and follow us. You can see the video of this on YouTube or on all of your podcast apps, Apple Podcasts, all of it. So we'll talk to you soon.
And if you have any other suggestions of topics you'd like to hear about,
let us know. We're always looking for new topics.
Yeah.
So, all right, thanks a bunch. Bye.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode soon.